Hi there, this is Matthew Morrison from The Practice, and it's an absolute pleasure today to have one of my business partners, Brad Davison, joining us. And Brad heads up the business advisory team here at The Practice. Brad, welcome.
Thank you, Matt. Thanks for having me.
But Brad, I wanted to interview you today because you're an absolute expert when it comes to structure and tax for people looking to buy investments. Brad, what are some of the big picture considerations in your mind that everyone should take into account before deciding on the ownership of investments, whether that be property or shares or other assets?
Yeah, Matt, basically there are three that any person that's looking to do an investment, whether it's a passive investment or whether it's an investment for their business, et cetera, the three main reasons we look at different ownership structures as opposed to, say, a business owner just owning these assets in an individual name. Number one, for asset protection purposes.
Yes.
Number two, for taxation purposes. And number three, for what we call succession purposes.
Fantastic. Look, as you and I know, so many clients come to us and so many prospective clients come to us to say, hey, I want to buy an investment or maybe borrow to buy property to save on tax. But what's your view of how high in the rankings of considerations is tax versus asset protection and succession and other flexibility?
Yeah, well, unfortunately, we're becoming more and more like the US every day, where people want to sue us for absolutely anything. So I always have a discussion with my clients around, you don't want to spend years and years building up something that you put your heart and soul in, you made some good money with over the years, just to have it all taken away from you by someone that's perhaps stepped into your business premises and has fallen over and got injured. And the next minute they're trying to sue you for everything that you're worth.
Yes.
In terms of tax, though, Matt, where it ranks, it's slightly just under the asset protection, so it's always number one. But I always say to my clients, never do anything for tax purposes, but if you are going to do something, make sure you do it tax effectively.
How about in terms of whether or not people should be considering buying assets in their personal name versus other structures? And we'll get into the details, some of the structures in a second, if that's okay. But what are some of the considerations when people are looking to buy an investment property around whether they should buy in their personal name or set up some sort of a structure?
Yeah, so there are a few considerations, Matthew. The first one is whether, I suppose, what chances are there of that individual perhaps being sued? And what I mean by that is a business owner who is wearing a few hats, i.e. they may be a director of their company, they may also be the shareholder of their company. They wouldn't be the shareholder of their company individually if they were clients of ours, of course, and they can also be an employee of their company. So first of all, we assess what is the risk of that individual being sued. And if that person is wearing all of those three hats, their chances are a lot higher than being sued than, say, just an employee who works for somebody.
Yes.
That isn't liable if something goes wrong in that business. So that's the first consideration. The second one is whether or not the investment is going to be positive or negatively geared.
Yes.
And what that basically means is positively geared is that the actual investment is returning a positive return or a net cash inflow versus an investment that is negatively geared, which actually costs you more to hold than what it returns for you.
A number of our clients are business owners, Brad, and let's say a business owner or business owner couple. What are some of the high level things people should consider when looking to own the family home, own the principal place of residence, to use that term?
Yeah.
And also have the business structure be run and owned and operated?
Yeah, well, the main one we tend to do in that situation, Matt, is we set up what we call a risk taker and a risk averter. So the risk taker, let's say that's the husband for this example. He may then be the director of the company. He may, though, not actually own any assets in his individual name, where his wife or his partner then becomes the risk averter, where she still may be working in the business with her husband, but she won't actually be listed with ASIC as being a director.
Yes.
And she may actually own some shares in her own name. However, the family home and any other assets that the couple may have would actually be owned by the risk averter, being the wife in this example. So if something does go wrong with business and the husband gets sued as a director or is made personally liable for something as a director of the business, that, hey, come and sue me. I've got no assets anyway. They're all in my wife's name.
So crucial as you say, to actually protect assets and protect wealth, but also have flexibility. If it was deemed appropriate for clients to actually own assets or own investment assets like an investment property or shares in a trust or in a structure, what are some of the main structures that we typically consider for our clients?
Yeah, so whenever you're looking to own an investment that's not going to be in your individual name for whatever reason that may be, generally the dominant purpose is asset protection, and obviously the second one being taxation. There are basically only two types of structures that we have here in Australia, the most common ones being a straight company, and the other one being some form of trust, whether it's a discretionary trust or a fixed or a unit trust. My preference would be that all investments are held in a trust. That's mainly due, Matthew, to taxation purposes. And when I talk about that, I'm talking more around the capital gains tax side of things when you decide to cash in on these investments that you've made. At the moment, and we can only advise with how the law stands at the moment, but this has been the case for many, many years. If you make a capital gain and you hold that investment or that asset in a trust, the taxation office will actually allow you to access what's called a 50% 12-month CGT or capital gains tax concession on any capital gain that you make, provided you've held the asset for a longer than a 12-month period.
Yes.
If you go to the opposite structure that I mentioned before, a straight company, that straight company does not avail or is not able to get access to that 12-month capital gains tax discount. So if I use an example of, say, you've made $1 million capital gain from a property that you might have owned for 30 years that was held by a trust.
Yes.
The tax office actually says, well, you only have to pay tax on half of that, being $500,000. If that same capital gain is made via the vehicle being a company holding that investment or that asset, it has to pay tax straight at the $1 million gain that it's made.
Yes.
50% discount. So it's quite powerful.
And that's before taking the gain out of the company, of course, via dividends or some other way.
Yeah, which in effect, then you end up having to pay more tax depending on who the shareholders are and where the dividends of the company end up. That's correct, mate.
How about, Brad, you mentioned before, you touched on succession planning and flexibility. What are some of the considerations around that, whether it be looking to build an investment portfolio in structures or from a business side of things?
Yeah, so one of the first things I always ask my clients, Matt, is what is your actual goal of getting out of it in the end, and what's going to happen along the way? Do you want an investment vehicle or a vehicle that is going to enable you to perhaps have future business partners in the structure? What is your end game? And often, maybe it's just that the husband and wife are just going to be the only ones running this business. In that case, it may be just more appropriate for the business to be run either through a straight company or just through a discretionary trust. But more often than not, we find that business owners want the option of, hey, I don't know what's going to happen in the next couple of years. I may have a business partner, or I may have an investor, or what that is, and I want a structure that allows me to do that. And what's called a unit or a fixed trust does allow them to do it, because they can later sell units down the track to either investors or new business partners. And the same can happen with a company. However, it's just not the most capital gains tax friendly environment.
When does it make sense for people to have multiple structures? And I'm talking more around business owners who might be running their business via a structure and say, hey, we've got a trust already and we're about to buy an investment property. We may as well just use the existing trust. When does it make sense to actually separate ownership and have different structures in place?
Generally, Matthew, I'm a believer of holding property in its own structure versus, say, a share portfolio in another. And what I mean by that is there's a lot, you're more likely to get sued by somebody renting out a property that you own than you are by holding shares in the stock market. So the last thing you want is to have a nice, juicy share portfolio held in the same trust or the same structure that you might hold an investment property, whether it's residential or commercial, because something may go wrong at one of those properties, and the next minute they're suing the entity that holds it. And hey, like in all insurance companies, they don't like paying out. Next minute they're suing the trust or the investment vehicle itself, and it's got a dirty, big, juicy share portfolio holding there. They can actually get access to that as well. So whilst it might be an extra $1,200, $1,500 to set up another structure, The way I explain it to my clients is that it's just another insurance policy, and it can let you sleep at night to say, hey, if something does go wrong, at least they can't touch our other assets or our other investments.
Yeah, I think it's money certainly well spent, especially if it's to protect good quality assets that are likely to be building and compounding for many decades.
Within a trust, Matthew, there are basically what we call three types of beneficiaries that are listed. And it's a little bit like our school system here in Australia and possibly in most countries of the world. You have what are called primary beneficiaries, and they're actually listed in the trust, in the deed itself. And anybody that's related to the primary beneficiaries, being 2 generations up and 2 generations down, and as far as you like across, they're automatically what we call default or secondary beneficiaries. So you've got the primary beneficiaries being the primary school, then you've got your secondary beneficiaries being anybody that's related to the primary beneficiaries. So that actually allows for, Matt, let's use you as an example. If you're a primary beneficiary of your discretionary trust, yes, it actually allows for your grandchildren as well to be default or secondary beneficiaries of that trust without having to be named every time that you have one. Thirdly, we have what are called tertiary beneficiaries, which is a little bit like going to university. And that's where when some business owners can set up what we call, traditionally called a corporate beneficiary, or sometimes referred to as a bucket company in our industry, yes, where you can actually send profits from many trusts to the companies as well, which can be used again as other investment vehicles. It can also be used for tax purposes. But it's really important to note, Matt, that any distributions or allocations of profits made to tertiary beneficiaries, the money actually flows to them eventually. Often people have heard of the term discretionary trust, and often they've heard of the term family trust. So yes, whenever you hear those two terms, they're just two different names for the exact same trust. Discretionary trust is the technical name. The most common name is a family trust for the reasons I mentioned before, that anybody that's related to the primary beneficiaries are automatically part of that trust. Those amounts that are distributed to any beneficiaries, they're required to report them as income as well in the particular year that they've been allocated the amounts, and subsequently pay tax on them.
How about the situation where, say, it's a husband and wife who are both employees and are looking to buy an investment property, or even looking to buy a parcel of shares and set up an investment account to build up via regular investments for the years ahead? What are some of the considerations? And let's say one's on the top marginal tax rate, and let's say someone's on a lower marginal tax rate. How should we decide, or how do we go about deciding whose name or names assets like property and shares should be in?
It comes back to what I said before about whether or not these investments are going to be positively geared or negatively geared.
Yes.
Often, if they're going to be negatively geared, the husband or wife who is on the higher income or in the higher marginal tax bracket, they may actually own that investment, so they can actually get the negative gearing benefits, i.e. additional tax refunds along the way, which helps them fund the investment. Conversely, Matthew, if the investment is positive or positively geared or generating income from day one, it would definitely make more sense to have it in the husband or wife's name that is generating a smaller income or a lower income, where they're in a lower marginal tax bracket, which means obviously they're going to pay less tax on any of that profit that's made from that positively geared investment.
And as we say, Brad, I guess any of these decisions should really be made in the context of a person's overall strategy.
Oh, yes.
Because it might be negatively geared to start with, but if they have the capacity to pay that down within 5, 6, 7 or 8 years, you don't want it necessarily to be positively geared in a higher marginal tax rate for many years to come. So,
and I think, Matthew, the key point is it's very, very rare in any situation, no matter what it is, an investment or in business or just in general life, where you can actually have your cake and eat it too. What I mean by that, I think one of our business partners has written a book on that. However, what I mean by that is that whilst we go back to the example I used about the husband or wife on the higher income and having a negatively geared asset in their own name,
yes,
when it comes to sell that, they have to report the capital gain in their own name as well, which can then also lead to higher amounts of tax payable at the end. So you can't sort of say, hey, I'm going to get the negative gearing aspects along the way, and then when I sell it, I'm going to make sure my partner reports the capital gain on that investment because they're in a lower tax bracket. So
yes,
without having a crystal ball, all these things need to be taken into consideration, not just looking 1 year ahead, 2 years ahead, 3 years ahead, but really, nutting it out, because all investments, as you know, Matthew, need to be for long term. There's very rarely do you make an investment in the short term that you do make some really, really good money out of it. So you really need to be looking to, 5, 10 years plus.
And I guess it really talks to, Brad, people seeking advice on the right ownership and the right structure before they buy, rather than rush off and buy a property or buy investments and then seek advice afterwards.
That's correct, Matthew, particularly with property, because the entry costs of stamp duty and having to change ownership structures are quite costly. Shares, it's not too bad, particularly if you pick it up early, because you can always, just pay some brokerage, might be $30, $40 to do the transferring. But yeah, particularly with property, you want to get that right from the start.
Brad, before we finish off, and look, I really appreciate you sharing your wisdom with us today, but before we conclude, are there any other considerations or ideas you'd like to share with us on the cementing structure piece?
Matt, the main thing is to seek advice from your trusted advisor first before you do anything. And that's what we're in the game of. If I'm going to build a house, I'm not going to go ahead and do it myself. I'm going to consult somebody that knows what they're doing. Yes. But to think with the end game in mind as well, and really stick to what your goals are, so we can make appropriate recommendations to your particular situation. And just know that it's not, there are people out there that can help with these sort of things that are experts in that industry. And the key is to get it right from the start if you possibly can.
It's an absolute pleasure to work with you, and it's an absolute pleasure to share some of your knowledge and your wisdom today. Thank you so much for joining us.
Likewise, Matthew, and thanks for having me.
Thanks, Brad. Cheers, mate.
Bye.